Have you ever heard that a product is going away and it's going to be off the shelf forever, so you got to run in and grab that product as quickly as you can because the new one's not going to be as good? But then afterwards you look at it and you say, wait a minute, was I just a victim of marketing? Because as I look at things, there's really not much of a difference. That happens in every single industry out there. So the purpose of this video and the next several videos is really to prevent that from happening by providing full transparency. We're going to dive right into the numbers on the 7702 update. We are going to look at whole life insurance products. We're going to look at a number of different companies. We're going to take this one video at a time though. But as we look at different products with different companies, each of these videos is going to compare the same company, same product, but different guaranteed rate. So anytime we look at an updated product that complies with the 7702 law, I want to see what did the old product look like with all things being equal from a policy design standpoint, and what does the new one look like. This way, if I'm a consumer, if you're looking to actually purchase a policy, you can make sure you've got full transparency and make the right decision, and hopefully decide to work with us. If you've got a relationship with another agent, that is perfectly fine. If you are in the business and trying to get more information and transparency because you hear from companies that, hey, this new update is the best thing ever, you're going to benefit your clients so much, but you look at the numbers and just kind of scratch your head, this is really meant to provide more transparency to help you provide just full disclosure information to your clients and not show them or tell them one thing and then have something happen later where they find out there's a better option and they say, dude, why didn't you tell me that? Not our best moment, is it? So let's get into it. What we're going to look at in this video, is a 10-pay product, which is a limited pay product, and we're going to look at funding it for 10 years. So a 10-pay product means we can make premium payments for a maximum of 10 years. And what we're going to look at when we examine the numbers, the guaranteed rate, I'm going to disclose that in a second here, but the guaranteed values, that's the most important thing, and then also the non-guaranteed values or the dividend values. So with the old product, the guaranteed rate is 4%. The new product has a guaranteed rate of 2%. So I see a big reduction in the overall guaranteed interest rate. Now, insurance companies have also cut their insurance expenses. So when we look at these, really what I am most interested in when I look at both the guaranteed and dividend values is not necessarily the rate, but the net internal rate of return. Meaning after the company's insurance expenses, all that good stuff, what do I actually net out at? Now, we've got our cheat sheet here on the right. Very important here. We've touched on this in other videos, but when it comes to this 7702 update, what a lot of people are not aware of is the fact that the guaranteed rate will have an impact on the MEC limit. Now, all insurance companies have had a guaranteed rate of 4% for a long time, since before I was born. I was born in 1988, by the way. I'm 33. So a guaranteed rate of 4%. This is based on a 40-year-old male. A $2.8 million death benefit obtains him a $100,000 MEC limit. A 3% guarantee only requires just north of a $2 million death benefit for the same 100K MEC limit. And if I have a product like the one we're going to examine here that has a 2% guarantee, I need a little bit less actually than a $1.5 million death benefit to obtain that same $100,000 MEC limit. So what that means is while the guarantee is lesser, the initial death benefit is as well, which allows me to push those insurance expenses down. There can be other advantages there as well. With banks, this worked out in their favor from a cash value accumulation standpoint, both on guaranteed values and non-guaranteed values. With consumers, it's a little bit different as you have two different products in itself there, banks and individually owned policies, that is. But I've talked enough. Let's take a look at the numbers here. Hopefully that was helpful in terms of providing some insight as far as what we're going to look at. So 10-pay product, funding 100K per year for 10 years on a 40-year-old male. Here's what we've got. On the left, we have the old product. Let's put everything for the old product in red. So old product, guaranteed rate of 4%. Guaranteed values, MEC limit of $100,000. Look at that. There's your death benefit of about $2.8 million. Now, funding here, annual outlay, $100K per year for 10 years. Cash value, right off the bat, in this example, about 80%. In the next video, you're going to see how we improve that early cash value with this particular product. This is a pure 10-pay with riders and everything attached, but it's not designed for early cash value. It's really designed for strong long-term performance, but that upfront cash value is quite low in my opinion, even when we designed it for maximum upfront cash value. But as I look at this guy, what do I see here? Time passes. This is the old product with a guaranteed rate of 4%, and your break even is pretty much year 11. You've paid in a total of $1 million and you have $999,000. Year 12, you are finally positive. So based on the pure guaranteed values, guaranteed rate of 4% with the old product, your break even is year 11. Annual IRR, what it is growing by each year net, and then the average IRR, factoring in all years. So we finally see the average go positive when you break even. That'll always be the case when you look at the average internal rate of return, especially on an insurance company's illustration if you select IRR. Now as time passes here, we do see that annual IRR increase and tops out right around 3.3%, a little bit less than that. The average IRR tops out a little over 2.25%. So if I earn 2.25% in a safe, liquid, tax-free area to position money, that's not bad, considering no risk and that the product with this particular company, one of the big four, has always done better than the guarantees. But with that said, we are examining the guarantees and what is the difference between the old product and the new product. So new product, guaranteed rate, 2%. $100,000 per year in. Now, look at this. These are both non-MECs. Very similar year one cash value. A little bit stronger on the new one based on the guarantees, but look at the death benefit difference. It's $1.5 million. The reason why, again, has to do with that MEC test. And if you are an agent, subscribe to our agent training business, this info, you likely have seen it already. If you're not subscribed, you can. We go through the full illustrations, the software, how to really put all of this together and see it firsthand from the company. But what do we see here as time passes? Your guaranteed rate is 2%. How long does it take to break even? Between 13 and 14 years, whereas the old one took between 11 and 12 years. Half the guaranteed rate, does it take twice as long to break even? No. A little bit longer in this example. Why it's only a little bit longer is that insurance expense was drastically cut. Now with that said, on the right, you've got the cash value difference. So for about the first 7 years, or first 8 years, you've got more money in cash value with the new product, guaranteed here, than you do with the old product. So lower guaranteed rate, yet out of the gates faster because of that higher insurance or that lower insurance expense. But as time passes, what do we notice here? That old one catches up, and boy, does it catch up fast. So that higher gross crediting rate will give the advantage to the old product. And this is the same individual, same health rating, same insurance company, same product, same premium blend. Everything's identical here except for the rates and the death benefits because of the MEC testing. But what do you notice the IRRs? Big difference here. So I'm going a ways down actually. But let's look at age 80. Old product, 2.215. New product, 1.474. IRR, 1.1%, $740,000 less than the old product. Look at the death benefit difference as well. So, looking at the guarantees, that is the trade-off. Because of this new 7702 change, it has helped insurance companies as they were really feeling the pressure and they were struggling by having to keep that guaranteed rate at 4%. because the interest rate environment, yields are so low and they have to maintain their safety ratings, AAA rating, all that good stuff. So by lowering the guarantee, of course, they're going to lower the guarantee values on their product, which makes things much easier for them as far as paying out claims and really sustaining them, or sustaining high credit ratings and being solid companies, if that makes sense. But let's continue on here. So the guaranteed values, that's the trade-off. So if I am a potential consumer and I'm comparing and contrasting, this is the kind of stuff I'm looking at. What's the trade-off? Guarantees are not as attractive for me, the policyholder. How about the non-guarantees? What do those look like? Which, when you look at the major mutual companies, they've always operated in a non-guaranteed element. They've always delivered not what their illustrations project, but we've seen solid performance. If, a big if things are designed properly, meaning a minimum premium. So let's take a look here. Old on the left, guaranteed rate, 4%. Same thing with the death benefit, MEC limit of 100K. We don't need to walk through all of that again because this is the exact same thing, just dividend values. Break-even point, year 6. New product, break-even point, year 5. A little bit richer up front, about 83% in this example. You're going to see those values boost in the next video when we pivot with the same product but with a design. Death benefit, 1.5. But what do we notice here? So you break even year 5, you're stronger out of the gates, just like you were with the guaranteed values. But what's it look like over time with this 10-pay product? Lower guarantee, but those IRRs look solid. Annualized, a little over 5%. The average IRR, if I look 30 years down the road, that's a while, but still, about 4.5% for safe, liquid, tax-free area to position money. Is that what I'm expecting it to do? No, but somewhere between that 3 to 5% range, I still am, old or new, just based off of everything we've seen. So interesting when we look at this, the question is, which one do you want? And I would encourage you not to select one based on this video alone, because in the next video, we're going to look at the same product, but it'll be extremely interesting when we make a tweak to maximize the long-term performance, keeping the funding the same just by exercising a reduced paid up option. So, hope you enjoyed this technical numbers video. We've got a handful to come. If you enjoyed, please hit the like button, subscribe for more, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.